Hey traders, happy Sunday. This is Ron Haight. Hope you guys are having a great weekend. As always, everything in this presentation is for educational purposes only. So the market's just opened. As I do this video, it's a little past 6 p.m. Eastern, and we can see, we're up a little bit here, but a lot can change overnight. So let's start by taking a look at the S&P 500 ETF, the spiders, using a daily chart. We can see the Corona crash, the rally. Let's go ahead and zoom in. This is this big trading range we've been in now for pretty much all of September, all of October, and we're just starting now to break out. And Friday officially is a breakout because the previous high was on 9.2, and that was 357.70 that we were outside of sort of this box, and we got to 358.10. So we had this big reversal. We just filled the gap on Tuesday. So Monday, big gap up, come off the highs, but now we're just pushing back up. And even though the selling volume did pick up a little bit, the direction of price is higher. This is bullish. Now, if I zoom out, you can see we are now at new all-time closing highs. So spiders is bullish walking into this week. I'm getting a lot of questions, on the election, what's going to happen, etc. As traders, it doesn't really matter. We just want to see what the big money's doing. And right now, the bigger money, if you will, is pushing it higher. And the first sign of trouble is going to be, I don't know if closing below the 20-day is going to be good enough right now, but it would be a little mini yellow flag. But when we get below the 50, that will be a sign that there is trouble again. Not end of the world stuff, because we have a trading range. So if this thing starts rolling over for whatever reason, we get below the 50-day, now we are put on notice. We want to pay very close attention to these charts. If we take out this little double bottom in here, that is a big, big deal. But we'll be doing these videos. I'll be doing the videos, each weekend unless something crazy happens midweek. And I'll keep an eye on this as well. We take a look at the Dow, same thing. We hit a new all-time high on Monday, and the previous high close would have been 295.72. So we really haven't gotten there yet, but we're pennies away from a new closing high. Here we haven't even come down and filled the gap. So if we get a little bit of a pullback, maybe it's a gap fill. That's going to tie in with the red line, the 20-day EMA, but the same thing here. We'd want to watch the 50-day. That is a full-blown technical sell signal, and then we would come back to the swing lows. Now the Dow, remember in last week's video I said here's a high, lower high, lower high, lower high, right? Here's a low, lower low, lower low. We are not setting higher highs. Well, that all changed on Monday. This is bullish right now for the Dow and the S&P. Oops, if we go to Qs, they're still range bound. Is that a negative divergence? Not really, because the Qs have outperformed the other two. So they're just taking a little bit of a break. That's not a problem at all. And here is the Russell 2000. If I take this back and show you, I'll do max weekly for all the data. You can see we finally put in new all-time highs this past week. This high from February was not a new all-time high. Now we've done it. So let's go back here to a one-year daily chart and zoom in. There we gapped up. And by the way, I get asked this a lot. Why is that a solid green candle? Well, we closed over here. Then we gapped up, so it's green. You're opening higher than the previous day, but then you closed at the lows of the day, but still higher than the previous day. So it's green because you're higher than the previous day's close, but it's solid green because you closed off the open, off the highs. This trajectory is higher as well. We now have a new closing high over even the big move up on Monday. The IWM now is bullish as well. If we take MDY, same situation. The mid caps are doing just fine. Now let's take a look at Apple, range bound. If I zoom in here, we have a high, lower high, lower high, low, higher low. This is basically like a pennant formation. There's nothing new from when I spoke to you a week ago. Technically, you're short-term bullish because you are above the 20-day EMA in red, but you're really just range-bound. About Amazon, range-bound. However, Amazon is beneath its 20-day in red and its 50-day institutional moving average in orange. So you could say, well, that's really bad. Look how it came down. Volume picked up. There's your spike in volume. The rally has been light. You're getting rejected. Yeah, that is a little mini bear flag, and it does look bearish, but in the context of the bigger trend, this is just wishy-washy. You are range-bound. It's not horribly bearish yet for Amazon. Where I would watch would be this little, almost like a tweezer type low from 11.2 and 11.3, we get below those lows, then things start getting more bearish for Amazon. Here's Netflix. Remember, its time to shine is not now. It's usually January. Yes, it's below its moving averages and it looks bearish, but it's really just range bound. Nothing really going on here. Adobe, again, almost like Netflix, it turns positive in January due to seasonality, just like Netflix. It's just going nowhere fast. Technically, it's bearish because we're below the 20-day in red and the 50-day in orange, but not much going on to be expected. Here's Google breaking out. It has not, yes, it has a new all-time closing high right there. If I take you back to the weeklies, you can see it. Google is bullish. First sign of trouble, close below the red line, and then the bigger one is the orange line. It closed below there. Microsoft, range bound, nothing going on. I always get questions about Tesla. Still no change. I have this little pennant drawn in, if you will. I could put it up at the top one too, but we're just chopping sideways within that pennant. If we get a breakout, that might be something that we see some momentum come in. How about pool? Everybody's seemingly buying pools because they're not traveling and they're putting pools in the backyard. Now, I love using the 50-day moving average in orange. It's not perfect, but it usually works pretty decent. So let's do a case study on this one. Here, pool cracked the 50-day back in the beginning of September, right after Labor Day, quote, the end of summer. That's a sign that the tide is turning, investor sentiment is turning. We break it, we come back up and hit it, we fall back down, but we put in a higher low. Once we get back above it, the charts instantly go bullish. Look what happened. A couple more days up, come back down, you hit it, and then it's a launching pad. Now, what's different this time around? Big, big, big down move. We close below the 50-day. That would be a sign of trouble. The very next day, we go right back above the 50-day, completely negates the previous move. And now we're just going back and forth. If pool were to close above the 20-day EMA in red, a gap fill would be the target. If we get back below the 50-day, I'd want to watch that close from the 9th, which would have been Monday. We get below there, then we come back down into the upper 290s. How about EA, where the 50-day is working amazingly well? Check this out. Here was the March low. Once we got above the 50-day on April 6th, get close, bounce, get close, bounce. One day bounce, we break it, and then we stay below it. We try to get up to it in October, mid-October, a couple days later, you reject it again, and then we get up there November 5th, about 10 days ago, and then boom, we drop on earnings. So this is showing a clear sign of a change in investor sentiment where what was once support, the orange line, that institutional line, now it's resistance. So if you said to me, what would be the first sign that looks like the bulls might be coming back? Well, we have past performance here. It doesn't guarantee future performance, but man, it's been pretty spot on since April. We need to get above that orange line on EA. Otherwise, right now, the downside target would be the March lows. Now, we had some other stocks we've been talking about with seasonality at Financial. This thing has a positive reaction to its earnings report, about 7 to 8 times out of 10 years, 70-80% accuracy rate. Up it goes, and then we're into what, the 130s? Even post earnings, it goes from mid 130s to almost what, low 160s? That's not bad. STL was another one. That's gone up post earnings. Disney, and what's interesting about Disney is it actually got above its 50-day the day before the positive news came out, as if someone maybe knew what was going to happen. And then we have the big move on Monday, and then we're still trading higher on earnings. It is so funny how this stuff plays out year after year. All right, moving on to gold. I'm not interested in gold until the end of December, as you guys probably know. Gold did break out on the 5th, and then we quickly gave it back on the 9th. So would I have traded that breakout? I did not, and the answer is no. I am a big gold bull because of what the central banks are doing. However, that does not mean I need to be a gold bull right now because the big money is typically not supportive this time of year. You might get those couple day moves, maybe something interesting happens out of the blue, but historically it's still dead weight until the end of the year. And we're back into our trading range. So I would say gold here on the dailies, it's actually bearish, but it's also range bound going back into September. Looking left to right on the chart. Silver, same thing. It gets up there the week before, and on Monday it comes right back down, right there, back into the range. And then GDX, gold miners, huge move. It's just not their time of year to shine either. And we come right back down below where we were. These guys are just dead weight until typically the end of the year. So that is it. Wish you guys all the very best. I'll catch you in the next video. So take good care and happy holidays. They are coming fast. See you later.